Welcome back to the Warlords of Wall Street. Well, today was one heck of a ride. Powell, as anticipated, raised interest rates by a quarter of a point again. That ended up being something that the market was anticipating, but his language and attitude towards what inflation was going to do, what they were going to do, ended up unnerving the market a little bit, but not as much as Yellen's commentary that the federal government wasn't necessarily interested in guaranteeing or expanding any of the guarantees through the FDIC, which insures most accounts up to $250,000. A little known fact that if someone is clever, you can go ahead and expand that FDIC insurance to cover an awful lot more than just one individual account for $250,000. If I have my account at $250,000, then it's insured. Now, if I also have another account with my wife's name on it, and that becomes a joint account, well, that also is insured up to $250,000. If I have, for the benefit of an FBO or an entrust of, or anything else, every time that there's a substantive change in the ownership or the interests of parties involved in a particular account, the insurance extends to that account too. So the nervousness that came out of SVB was mostly because, as a lender, you're going to ask corporations to put more and more of their money with you if they expect you to be their principal bank and lend them money. It's a common requirement. Is if you're lending to XYZ business, you want their employees' accounts there. You want the bank's operating. You want the company's operating accounts. You want to do the working capital loans. You want their lines of credit. You want them processing their credit card transactions through your bank. If the owner's going to buy a car, you want to finance it. If he has a house, you want the mortgage on it. If he has a boat, you want to do the loan on it. If he's leasing equipment throughout the company, you want to be the one writing the leases. It's just one of those things, and SVB was no different than anybody else. But one of the, downsides of it is at times there could end up being an awful lot of money in a corporate operating account that isn't necessarily insured. Because it's well beyond $250,000. There may very well be millions upon millions of dollars in payroll accounts and operating accounts, and all of a sudden the bank ends up having all kinds of problems. Well, then that could be an issue. There's no doubt about it. Yellen's comments seemed to overshadow what Powell was trying to say. He did foreshadow another quarter of a point bump at some point this year, but what the market didn't like hearing, although the bond markets are disagreeing with what we're seeing there, Powell said that don't look forward to him backing down rates in 2023. Well, the fact of the matter is, perhaps 2023, we were always speculating over here that it would be in the fourth quarter if it was going to be anything. So it wouldn't be any great surprise if in the first quarter of 24 they decide to do it. But a rate cut is coming. There's no doubt about it. I think the CPI data is clearly showing that we've reached our peak inflation and everything's going to be trickling down, slowly perhaps, but trickling down nonetheless. The rate hikes are obviously going to affect the banks and their credit portfolios. We discussed that over the last couple of 3 days. Is that all the banks, bond portfolios that they've barbelled to offset the risks of their loans are all probably technically underwater. I don't even think all probably and technically. They are all undoubtedly underwater, and that is a bit of an issue. I don't think it makes anybody other than just technically unsound. I don't think there's anything to worry about it. I think it's all overblown. And in light of that, we're going to go ahead and continue to take advantage of that volatility. You've heard us talk numerous times about our our playing of the Direction Regional Bank Fund, the DPST. We picked it up the other day at 785. Turns out that it ran up to about 977 the other day and then started back down. We had our trailing sell limit, as we always do, and we got taken out a couple of percent as it started to drop. And glad that we did, because today they dropped it back another 15%. And here we have the direction is right back in our laps, and we have an opportunity to pick it up again at the 785 range, give or take. And we think within a dime or so, we may very well be coming right back into this again. I'm not looking for too much more than 5% or better, but she seems to be willing to give us 10 to 15% on the swings. So I continue to like it here, although it's an aggressive play, as I've said. But the regional bank fund ends up looking like something that maybe somebody should take a look at for a long-term hold. There's no doubt that these banks are going to be fine. It may be as much as a year from now, but there's a significant, if you look at the price history chart on that, as the banks recover and it goes back to its old trading ranges, for that matter, banks and other cyclicals, when the economy begins really to reboot and when the Fed stops cutting and maybe even reduces for the first time, this market is going to take off and it's going to be very strong. And the banks and the cyclicals will lead the way, because clearly the ones who get beat up the most in times like this always end up leading the charge out. And that certainly is the regional bank's case. So we will continue to watch what the bonds are doing. We're excited about the opportunities that the market has. Wasn't particularly thrilled today at the performance of the tech stocks in our portfolio, but it's just one of those days when you have to ride the dragon, and ride the dragon we do. So that'll be it for today. Keep your powder dry, take your profits where you can, and be safe out there.